Also with us, John Lynch, the chief market analyst at Evergreen Investments, which manages $155 billion in assets. He says stocks are now a buy below 1,100 on the S&P. And still with us, David Tice, founder of the Federated Prudent Bear Fund, which has beat out 98% of its peers over the past 5 years. John, let's kick it off with you. So another down day here. I'm going to ask you, I asked Barton Biggs this, if you're getting nervous here. He doesn't seem to be getting nervous, but are you in this market environment?
Well, it's never relaxing to see the market down like it is today, but I'm still holding true because I still share some of David's concerns about the longer-term secular challenges facing us. You know, at some point we're going to have to pay for all this bailout. I still think some of the shorter-term or cyclical strengths are still strong enough that can enable us to trade in maybe a 250-point range on the S&P 500. Call it buy south of 1,100 and raise some cash in that 1350 level.
Is it even worth it if that's the case? I mean, if you're concerned long-term, you do think we're in a secular bear market, wouldn't you just want to prepare for that? Or how long do you think we have?
Well, I don't think you should hunker down like that, because if you look at history, when you see periods where the economy is heavily dependent on government spending, whether it's the 30s or the 70s or recently here, Japan in the 90s or the 2000s, you have, you know, the economic V, if you will, shorter term as a result of government stimulus, but you have accelerated market volatility. And I think it's critically important to appreciate the power of compounding and to try and be, if you will, tactically strategic or strategically tactical. I'm not trying to turn everybody into a trader, but I think diversified portfolios can try and take advantage of some of these support and resistance levels.
David, on the one hand, I'm hearing him say, don't buy David Tice's fund. On the other hand, you oftentimes will allow that we could have some gains before we have the drops. I mean, do you disagree with what he's saying?
Well, you brought up a great point, Matt, in terms of is it worth it? And really, there's a lot of people that are saying 10% up on the S&P, maybe 15% up. However, I truly think if you're honest with yourself, there's certainly a chance of a 40% decline. Look at the magnitude of all these problems. And therefore, do you really want to take a bet of 10% up versus 40% down? The other thing, most of the people watching this program are already wealthy. They're going to do very, very well. Another 10% isn't necessarily going to change our life, but down 40 or 50% really can.
You know, I want to bring in another
point, if I may.
Everybody wants to
point, if I may. The relative strength index is at 30, which is exactly where we were in early February before we began the next leg up.
You know, I want to bring David Tice in because he's been listening to this, kind of gesturing here.
Yeah, when you look at longer-term technical trends, we had an 80% rally in the market after our big 07-08 decline. We rallied about 61.8% retracement. That, in Elliott wave terms, that's essentially the reflex rally that you have after a big decline. If this secular bear thesis is right, that we had the rally, now we're going to resume the secular bear, and there's a lot of technical confirmation for that.
Brini is indeed saying if you look at specific company profits, he's encouraged by that. John, I'm curious what you think on that front.
Yeah, thank you, Julie. I agree with the gentleman you were just referring to, with Lazo Brini, because when you think of it's a game of quality, right? We have a lot of cash. We have very strong balance sheets. It's not the income statement game anymore, I believe. I think it's a balance sheet game. And, you know, hearing some of the numbers that David has tossed around, you know, I thought I was bearish because I'm $10, $15 below Wall Street consensus from a profit forecast. So this is rather cathartic for me. So thank you, David. I'm using maybe $85 in earnings next year in what will still be a low interest rate, low inflation environment. A 16 PE on 85 is $13.50 fair value. But I share a lot of David's concerns on how different instances, episodic risks are going to periodically surface and cause us to test the trading range, which is why I think below 1,100 is a buying opportunity. Now, heaven forbid we have a geopolitical event. You look at a 20-year chart. I mean, if it's a geopolitical or terror attack, could that bring us to the 900 level? Absolutely. But we have an awful lot of support in that area, and I'm hard-pressed. I hope we don't go lower than that.
Gee, I mean, aren't the chances of geopolitical event climbing every day as we watch the kind of riots in Athens that bring on a flash crash, and also Germany acting alone in Europe, which is one thing that you got to be concerned about, even if it is 60 years later?
Yeah, Matt, look at
Matt,
look at the litany of factors.
Matt, you can look at us. Go ahead, David.
Okay. We have Thailand. You know, looks like 30 people were killed today. We have what's going on. China is ultimately going to be a basket case, in my opinion. I listened to Jim Chanos, who called Dubai, who called Enron, et cetera. He thinks this is a bubble 1,000 times bigger than Dubai.
That's point out a lot of people disagree with Jim Chanos on that.
Yeah, I tell you, I've had people go there. I think he's right on there. You look at Greece, the issues in Greece. You look at North Korea. Look at the news in North Korea just recently.
So it's all out there in your view. It's all out there, right, David? Okay.
Iran, Israel.
Just sell here? If you're still holding on to any kind of equity positions at this point, based on your outlook?
As a long-term investor, I think you should lighten up. I think you should sell. Now, we are getting oversold here. There will be bounces. We think this will be a stair-step decline. The market could rally for a little bit.
Could we see something similar to what we got from the March 2009, that huge run-up, and could it go on for several months?
You don't? I really don't think so. I think we might have a 2-week rally. However, 6 months from now, I believe very, very strongly the market's going to be far lower than today.
I want to let John have the last word here. John, only about 30 seconds left. Do you, as someone who's at least in the short term still enthusiastic about the U.S. economy, see this as a big buying opportunity, and will you do so today or tomorrow?
I do, Matt. I agree with David. I don't think it's a rally from the opportunity of February 09 or March of 09, but I do think it's a rally opportunity from February 2010, and I think that's where you should build positions and think about that sustainable trading range, south of 1100 to, again, on a conservative earnings estimate, a conservative multiple, I think we can be north of 1300 year-end 11.